Dennis Gibb is back, and Dennis, you welcome back. First of all,
yeah. Let hear the applause of the audience.
I can hear it. Yeah. Woo! Look at the girls, man. Look what they are doing.
Yeah.
They're excited for you.
Madonna's got nothing on me. Let me tell you.
So Dennis, a lot of people. I think a lot of people are following this. The Facebook deal, the IPO, the big one, I guess you could say, and. In kind of keeping along the conversation of top performers, whether it's a quarterback or a Madonna, Facebook truly has kind of become one of those top performers, extremely well known in top tier businesses or websites. And so now we got, they're gonna let you buy a piece.
Oh, goody.
You seem like such a Facebook user.
Oh, goody. I had a Facebook page and I took it down. Because I found out that I was being, the people who wanted to be my friends were people I didn't like when I was in high school and college, and I still don't like. And so why would I want to be Facebook friends on them, electronically? I didn't like them in the flesh.
Well, that way you can keep up with their kids and their grandkids and all the cute pictures, Dennis. That seems like you.
Yeah, right. And I had so many, and I found I was only going on the thing twice a week. It was useless to me. And I was finding, anyway, it's a personal choice. I know a lot of people who aren't, curmudgeons like me, really like Facebook. It's their way to communicate. You see them all the time with their little smartphones, and they're posting stuff. I'm at Starbucks or whatever, doing this. Yeah, but Facebook has literally become a figure of speech now. It's a verb. It's a noun.
It's like Google it.
It's like Googling it, or I'll check it on Facebook, and so it's very popular. Certainly with younger people, it's very popular.
And Dennis, everybody's younger to you.
Of course, that's why you're talking.
I got to throw those out there.
Well, you're talking about Madonna being an old lady, right? Come on, the woman's what, 50?
53 and 4 months. We looked it up at halftime because we were trying to figure out. We did. We Googled it. And we checked out her Facebook page to determine if it was accurate or not. She had a lot of fans.
I tell you, I hope I look that good at a 53.
Me too. So let's talk a little bit about people wanting to buy into Facebook. I mean, a lot of people kind of think, well, geez, should have bought into Google day one or should have bought into Apple day one. And that technology craze is still kind of out there, even though Facebook is already a behemoth.
Mm-hmm. Yeah, it's got a lot of people looking at it. And there's a big difference. I mean, when a syndicate offering, an IPO, initial public offering, is made, it's done by a syndicate of investment firms. In this case, Morgan Stanley is leading the syndicate. Goldman Sachs is part of it. There's a few other people. So the only people who can really sell the shares are those people. So if you don't have an account with them or some relationship, you're probably not going to get any shares. In addition to that, when you have a deal that has this much demand, everybody wants this thing. And the firms are going to use this as a way to suck in more business. So if you're out there looking for shares and Fidelity wants 8 million of these things, your chances you're not going to get any shares. So you got to think about whether you really want them. The second thing you got to look at, you got to think about the company. While it's a big company, they are selling they're selling A shares and there's B shares. The A shares have 1 vote per share, but the B shares, which are held by the insiders, have 10 votes. So Zuckerberg will be absolutely in control of this company. He does not have to submit any of his board of directors to anybody except himself to approve. He is totally in control of this company. So as a shareholder, you have no vote in what's really going on there. So if you don't like Mark Zuckerberg, you got a problem. In addition to that, this thing is being valued very highly. It does about $1.8 billion a year in operating earnings. And the valuation of this company is 150 times earnings.
That's very high.
Yeah, routinely high. I flew on airplanes lower than that, at lower altitudes than that.
What's that typical earnings ratio?
Well, it depends on what you're looking at. If you're looking for a non-technology company right now, it's probably going to come between 15 and 30. If you're looking at technology companies, most of whom are still in development stages, you can have a higher ratio. You can get up to 50 and 60, but 100 seems a little high. That's .com days.
Almost unprecedented. So, but even if people do want to go in and get this, you talked about Morgan Stanley being able to offer most of these shares. Mm-hmm. How would somebody who does want to get into Facebook, how could they? Do they have to go open up are they going on Morgan Stanley right now and opening up that account? You can try that. Many times they have a rule that says that if it's a new account, you can't buy initial public offering shares because they don't want people just coming in to buy the shares and not buying it anymore.
The chances are for most of the consumers out there, you're not going to get any stock. And even if you establish an account, they're not going to give you any stock anyway. So there's no requirement for the brokerage firms running this to give anybody any shares.
Sounds almost like insider trading.
Well, it's not insider trading. It's called profit. That's just how these guys make money. Is the fees on this thing are going to be enormous, and by controlling the shares that are going to be traded in this thing, they make more money, and they can go out to big accounts. They're going to do millions of dollars in commission revenue through them, and they can say, look, if you do X amount of revenue with us, we'll give you so many Facebook shares. Now, that's sort of illegal, but anyway, that's the reality is, on Wall Street, the border.
It's gray. It's all gray.
It's all gray. There's no borderline out there.
If somebody, let's just say somebody were able to get in and maybe they have their Morgan Stanley account. I seem to remember companies like LinkedIn and Zillow where they come out and by midday of the initial offering, they've almost doubled.
Yep.
And then they come tumbling back down to
Right.
maybe right about where they came out.
Right.
Who makes all that money?
Well, there's a group of people out there called flippers. And they get in there and they buy these stocks on the IPO, and they know that the thing is going to be marketed in such a way that demand will be more demand than there are shares. So if they can get in on the IPO price, then they let the stock run and they'll flip it and they'll make 10, 15, 20, 25%, or sometimes even double. So when the stock goes up, you'll start to see the selling coming in, and people will start selling the stock short and everything else because they figure it's going to roll off. The next time then the stock goes back down, then it rises back up. The next time that happens is when the lockup period for the insiders and everybody else comes off, and then all those shares start hitting the market, and that's got to all be digested before the market goes off. So a lot of these things don't continue to go up. And this deal is being done. People are comparing it to Google, but Google did it differently. Google did what's called a Dutch auction, and they let people put bids in on shares. I'll pay this much for Google or this much. And so then they came to a kind of a comparison of what everybody wanted to pay, and they priced the thing at like 89. This is just the underwriters here are just going to go out and say, this is the price. And if you buy it, it's going to go up. Now, frankly, if I were Mark Zuckerberg or somebody's management and I priced the stock at 28 and I saw it go to 50, I'd fire my underwriters because that's money I left on the table. I'd rather have them price it at 30 and have it go to 50 than have it double in the first day. It doesn't help me, but it's going to be a big one.
He's hurting too. He doesn't have enough money.
Oh, he doesn't have enough money, right? Yeah.
But so I get what you're saying for sure.
Facebook will go up the first day. After that, it's all off. I know people on the street who think that this thing is the next Google. I know also people on the street think it's the next Enron. I don't know. I haven't read the 246-page prospectus yet.
Do you think that when people go and we've talked actually about this before, how hard it is as an individual investor to quote unquote win? And this seems like another one of those things where, I'd love to invest in Facebook, but it's so hard for, myself or maybe people who are listening as the individual investor to really capitalize on something like this because of all the kind of behind the scenes action.
You play roulette?
I'm more of a craps guy, so I like to lose faster.
Same deal. The odds are the odds, okay? If you play games where the odds are against you all the time, you will lose. So rather than chasing an IPO, chasing a single IPO or 2 or 3 IPOs, why not just sit back and go after some smaller things and pick up 5, 10, 15% a year, pick up dividends and this and build it up slowly. Then you can be one of these big guys and you can say, okay, it starts to work. This game is about money. The more money you have, the better, the more you get to write your own rules. The individual investor needs to figure out what it is they really need to do in their lives. And everybody in America wants to get rich quick. We all know that Mark Zuckerberg just got rich quick. He wrote this formula. You saw the movie. He wrote a formula, and suddenly he's a billionaire. Didn't happen that way. We all know Bill Gates got rich, right? He had to live for 18 months with Paul Allen in a motel room. That's punishment enough. We all think, Steve, if you read the biography of Steve Jobs, it was years and years and years of experimenting and fooling around until they finally got the formula right to make this thing work. It doesn't happen overnight.
They really are like computer scientists where they play with these formulas almost as if they're a chemist.
Yeah, and everybody thinks all you got to do is have write a mathematical formula and you can suddenly do something. It doesn't work that way. It just doesn't. So you have to, and this is what I counsel my investors on. Look, don't try and hit for home runs every time. Hit the single. It's easier to hit 4 singles than it is to hit home run.
We're here with Dennis Gibb, president of Sweetwater Investments. Dennis, we have a few minutes left. going back to these home runs, a lot of people thought they were hitting home runs back when they were buying houses.
Yep.
And now that home run, their home run, I guess, has been robbed as we stick to that. Ichiro climbed the wall, got one.
Right.
And now you have these big banks who are settling these mortgage fraud issues, thinking that, hey, or maybe helping people think that maybe that home run still has a chance of getting out of the park. Or they're going to have a little bit of retribution coming from these banks, but ultimately you've called it a total ripoff.
I think if anybody out there thinks that they're going to get made whole on this thing, on a house that's underwater, they should probably bend over and grab their ankles because something's coming. And it's not very pleasant. Sorry about that. See, the engineer is sitting here.
Eric, what do you think, man? We're way after.
Let's keep it friendly, shall we?
This is a way for the banks. The banks are supposedly going to pay $25 billion for errors in the mortgage business. What they're really after is the last part of this, and that is once they pay the $25 billion, they are immune from prosecution. And that's what they're really after.
So the carrot is quite different than helping the common man.
The way I've seen it figured out is there's going to be about $17 billion, which is going to be available for underwater mortgages. If everybody in the United States who's underwater applied for this, they get about $17,000 reduced off their mortgage, which, given whatever your mortgage payment is, that's about $35 a month.
If you live in Detroit and bought a house in Detroit,
it could be the entire house.
You probably own it free and clear now.
Now,
so.
Clint Eastwood will be after you in a minute here. I mean, Tom, you got to be careful. It's halftime in America.
I thought that was going to be a Republican National Convention ad, in all honesty.
No, I figured he was going to say something
or just the NRA was coming right through.
But they're trying to work a settlement out here, and the president proposed in the State of Union a new commission at the Justice Department, which is supposed to look at mortgages. One of the problems is that like fraud has a statute of limitations. And a lot of this fraud that went on in 2006 and 2007, the statute of limitations is about run. So if they don't prosecute these people pretty quick, they're going to walk. And unfortunately, I got to tell you something else. A lot of what happened with this mortgage stuff was not illegal. It was unethical. It was immoral. It was wrong, but it was not strictly illegal. So there may not be a prosecution on some of this stuff.
Well, I think it still comes back to there were always buyers for these things. The people wanted the loans got sold to a bank, the bank went and securitized, or sold it to a security,
sure.
And then the Europeans bought them, and they're doing real well with that too.
The Eskimo villages. And the other thing that happened, of course, is that, the dot-com boom busted in 2000. And so, of course, immediately people went out and they took their money and they said, I got to get back on that. And so real estate became the place to go. And then one thing led to the other. I mean, nobody forced anybody to buy a house they couldn't afford. Nobody forced anybody to do this stuff. You could just walk away, but people went out and bought them. And yes, they can say you were induced by the banks, pay low rates. I mean, come on,
Somebody has to read what they're signing. And, on the flip side now, we actually had this big conversation about this. We'd have to go to break here in a second. But in a training we had in the mortgage world, and we're talking about, is it ethical to short sell your house because you have made this bet or, you bought this house. And I'm kind of torn because part of me is thinking, well, yes, you should pay that back. But on the other side, you have two bad bets that were made, and you get to choose if it was yourself or if it was the bank. And, where does your moral obligations lie? Is it to your family and to your retirement and putting your kids through school? Or is it to the piece of paper and the house that you purchased?
Well, I think that belongs. I think if you go over to the Archdiocese of Seattle, that's more their discussion than mine.
And that's what I said. We can give some financial advice, but we don't preach religion here.
Exactly.
Well, Dennis, thanks so much for joining us again. That's Dennis Gibb, president of Sweetwater Investments. When we come back, we are going to definitely talk, well, maybe not so much about the finances and what's ethical, but we do have a lawyer on hand. Brad Duncan's going to join us with David Wright Tremaine. My name is Ben Brashen. That was Dennis Gibb. This is Brashenomics.